YouTube channel, AI Fusion Hub, and sorry for the delay. The video today discusses why private equity is a great idea. In theory, funds take investor money, buy a bunch of fledgling or faltering companies, shuffle around their structure and leadership and operating model, grow their worth, then sell them a few years later for a profit. What's wrong with that? Let's dive deeper into how funds operate. They take investor money, buy a bunch of fledgling or faltering companies, shuffle around their structure and leadership and operating model, grow their worth, then sell them a few years later for a profit. But what exactly is wrong with that? For example, do you remember Yahoo? In the early 2000s, it was an icon of the early internet. It was consistently worth more than Amazon and Apple combined. Its market cap reached a high watermark of over $125 billion. But today, it's known for what it isn't. After rejecting a $44.6 billion purchase bid by Microsoft in 2008, a decade of decline led to its eventual sale to Verizon for a humiliating $4.8 billion. Verizon then merged the company with AOL, previously bought for $4.4 billion. But after the downward trend continued, Verizon finally sold the combined company for just $5 billion, an enormous loss. The buyer was Apollo Global Management, a behemoth private equity firm previously headed by Leon Black until his $158 million in payments to Jeffrey Epstein emerged in the media. Through the years, Apollo has owned and transformed companies like ADT, Chuck E. Cheese's, Qdoba, and AMC Theaters. But this time, they believed there was value to be had in the beleaguered web services company, Yahoo. For their strategy to work, they needed a leader. And for that, they turned to experienced businessman Jim Lanzone. Part of the reasoning was surely that this wouldn't be the first time Lanzone attempted to turn around a faltering internet business. He made a name for himself while working at Ask.com. This company started as Ask Jeeves, an early and promising competitor in the search engine space focused on natural language processing, much like today's AI-driven chatbots. Google, of course, won that competition. So the company pivoted its business model to center on questions and answers rather than search, and correspondingly rebranded as Ask.com. It was around then that Jim Lanzone was appointed CEO, and while always overshadowed by the company's fall from its promising early days, Lanzone was recognized as having finished his term as CEO with the company on a firmer footing, and is therefore credited for its continued survival. In the years that followed, Lanzone went on to lead CBS's digital business leading up to its massive merger with Viacom, and then was briefly CEO of Tinder in 2020, so Apollo believed he had all the experience for the job. This new leadership team, CEO Lanzone and investor Apollo, started by selling off extraneous yet valuable assets Yahoo had acquired through the years. They wanted to focus on the company's core, rather than just acting as a collection of random revenue-creating resources that managed to survive through time. So the key assets of the comparatively strong and independently operated Yahoo. Japan was sold off to its other owner, SoftBank, for $1.6 billion. Then Edgecast, a streaming technology company that the former owner had grouped into the Yahoo-AOL merger, was sold for $300 million. And what worked was clear: Yahoo Finance and Yahoo Sports. Through the years, each had maintained and gained a reputation as the best places to go for investing and sports news and data. So to double down on success, they once again hired from experience. Ryan Spoon's time at ESPN and BetMGM gave him context into the fantasy sports audience that drives so much of Yahoo Sports traffic, so he was tapped to be that division's president. Tapan Bhatt's time as chief product officer of NerdWallet informed his experience in the wants of the newest generation of retail investors, so he was appointed general manager of Yahoo Finance. Structurally, within Yahoo, each of these core divisions was given a high degree of autonomy to build out unique product offerings for their specific customer bases. Yahoo Sports started work to bolster its sports betting offerings, including acquiring sector startup Wagga in 2023. Yahoo Finance focused on growing its subscription-based offerings, and its Yahoo Finance Plus platform, offering advanced trading tools and data, is reported to now have more than 2 million customers and double-digit year-over-year growth. The details of what Apollo and this new leadership team are doing go on and on, but in short, Yahoo has gone through a transformation marked by cutting off its appendages, reinforcing its core, and it's working, while obscured by the lack of reporting requirements due to its private ownership. All indications suggest that the company is, while smaller, as healthy as it's been in decades, and the CEO has said that it's on the path towards IPO and is very profitable. However Apollo exits this investment, it will almost certainly yield them a tremendous return. And it'd be fair to argue they will have deserved it. They came in, took a risk, found a new leadership team, developed a viable strategy, then shepherded the company through a transformation. They took an obsolete institution and brought it back into relevancy. Structurally, private equity firms are not complicated. Their cores are the general partner. General partners typically know the right people. It is not an entry-level job. To take the example of a rather random, rather unremarkable firm, J.W. Childs Associates was founded by general partner John W. Childs after a long and successful stint at Thomas H. Lee Partners, founded by Thomas H. Lee. Thomas H. Lee founded his firm after a long stint at the First National Bank of Boston, where he rose to the rank of vice president. Other examples of private equity general parallel include Mitt Romney of Bain Capital, who was also the 2012 Republican nominee for president, and Stephen Schwarzman of Blackstone, the 34th wealthiest person in the world. These connections are crucial thanks to step 2 in the process, raising money. Typically, general partners start by throwing in a couple million of their own money to set the stakes. Then they'll go around pitching investors on why they're the best person to manage the investors' money. Often it has something to do with having particular experience in a particular industry that is particularly attractive for particular reasons. In the case of J.W. Childs, he likely went around arguing that he had a particular knack for investing in consumer food and beverage companies, since at his prior firm, he had helped arrange the buyout of Snapple for $135 million in 1992, which his firm sold 2 years later for $1.7 billion after massive revenue growth. And he'd likely argue that food and beverage companies are great for investment since people have to eat and drink, and therefore the sector is less subject to the cycles of the market than something like tech. This sort of stability is particularly attractive to the massive institutions that make up the core of private equity investors. In John W. Childs' case, insurance companies like Northwestern Mutual or employee pension funds, like the Bayer Corporation Master Trust. Individuals can theoretically invest in PE funds, but only if they hold enormous wealth. It varies dramatically, but many funds have minimum investments upwards of $25 million. Meanwhile, the way private equity firms themselves make money is remarkably consistent. They just take 2% of it. 2% of all money each year is taken as a fee, regardless of whether or not the firm actually grows the investment. But then to incentivize returns, the firm also sets a benchmark called a hurdle that they're aiming to beat in year-over-year investment growth, say 7%. Any money earned on top of that hurdle is then subject to a 20% fee that goes back to the firm. So, say, if a fund was originally worth $100 million but grew to $110 million, $3 million would be subject to that performance fee, and so 20% of it, $600,000, would go back to the firm. In practice, what's earned from the 2% base fee is fairly consistent, since there are generally restrictions as to when investors can take money out of the fund, so the sum does not generally fluctuate rapidly. Therefore, firms typically earmark this base fee for covering basic operating costs like office rent and analyst salaries. This is what's referred to as a leveraged buyout. The fund puts in some of their money but primarily relies on borrowed money to pay the seller, just like a homebuyer with a mortgage. This magnifies the potential earnings, but in turn, of course, the potential losses. But it's worth considering what this does for the general partner. In a $100 million fund, buying a $400 million company with 75% borrowed money, very small margins of growth can make all the difference for this one individual. With a 7% hurdle and 7.5% growth, 20% of the margin above 7% on that $400 million company would earn this individual $400,000. But if instead the company reached 7.75% growth, the general partner would earn $600,000. Because of this amplifying effect, every 0.25% growth, a rather small difference, earns the general partner another $200,000 in income. At no point did Marsh reach the size or level of national ubiquity as Yahoo. If you aren't from Indiana or Western Ohio, you've likely never heard of Marsh Supermarket yet. While confined to just 2 states, Marsh Supermarkets and its private equity takeover exemplifies a pattern that spans all 50. The first Marsh opened here, a small local grocer catering to specific local needs in Muncie, Indiana in 1931. The simple concept took weathering the Great Depression, then outlasting World War II. The budding Indiana institution began to expand. By the 1950s, there were 16 Marsh locations across the state. By 1952, there was a Marsh distribution center in Yorktown, Indiana, and by 1956, the store was expanding into Ohio. As demands changed in the 60s, the company adjusted. Marsh Foodliners became Marsh Supermarkets, growing in size to accommodate one-stop shopping. Diversifying as decades progressed, the company also established its own convenience store, the Village Pantry, its own bargain bin store, Lowbill Foods, and eventually purchased its own upscale grocers in Omalia Foods and Arthur's Fresh Market. Blanketing urban and suburban Indiana and Western Ohio, Marsh and Marsh Properties were a mainstay through the 90s and 2000s. And it was at about this time that Sun Capital became interested in the company. Today, there are 0 Marsh locations in 2017. Unable to keep up with rent payments and struggling to pay vendors, the company filed for Chapter 7 bankruptcy, closing every last location and liquidating all remaining assets. Like an empire spread too thin, Marsh had reached its territorial epoch before collapsing in on itself within just 2 decades. All on a timeline that rather neatly lines up with the brand's time under Sun Capital's ownership. Now, Sun Capital Partners didn't instigate the regional grocer's fall from grace. Private equity fixates on industries, regional grocery chains like Marsh, casual restaurant chains like Red Lobster, odd-end industries like animal retail and veterinary care, and, most unnervingly, the most consequential industry of them all in healthcare. In most cases, only the sharpest-eyed consumer notices the subtle changes, but frequently enough, private equity's internal tinkering turns things sideways. The local market goes out of business, the menu items track upward in price, the understaffed and overpriced veterinary clinic's care drops in quality, the elderly home's staff unintentionally neglects a call for help. All this happens in the name of efficiency gains, cost-cutting, and corporate streamlining, bad outcomes not even private equity firms can deny. On average, headcount at public companies bought by private equity shrinks by 12% over the following 2 years, translating to thousands upon thousands of layoffs. PE-owned nursing homes see 11% higher mortality rates than the non-PE-owned counterparts, summing to a total of 1,000 excess deaths per year. Companies acquired by private equity firms through leveraged buyouts are found to be 10 times more likely to go bankrupt in the following 10 years than those that are not. Theories abound as to why a benign structure leads to such malignant results. But none are surprising. They all have to do with what happens when one shrinks a conglomeration of hundreds or thousands of people, their relations, their creativity, their capabilities, their faults, their everything, down to a deluge of figures on a spreadsheet. The stories of a private equity firm going in, working on the human level, changing the fundamental culture of a company in a way that strengthens collaboration, creativity, innovation towards the end of just creating a stronger, more competitive product for their customers are tough to come by. The stories of a private equity firm going in, hiking pricing after their analysts told them they could, hiring lobbyists to create more favorable legislative conditions, initiating mass layoffs for divisions that are not yet profitable, saddling companies with debt in complex financial maneuvers, shuffling assets around to create the illusion of transformation, sacrificing future potential for present-day returns. Those stories and their calamitous human results go on and on and on. Exploitation is easy without emotion. When the person making decisions is the same person unlocking the door each morning, it is much more difficult for them to profit off of their employees' suffering. They have to face the consequences of their greed face to face, and that's uncomfortable. When the person making decisions is the boss of the vice president whose senior associate manages the associate who sits on the portfolio company board which appoints the CEO, whose direct report manages the division, whose vice president manages the regional manager who oversees the branch manager that unlocks the door each morning, exploitation in the name of profit is easier. And those small number of individuals at the top, the general partners, have all the incentive in the world to exploit on the margins. Because of the compensation model, the industry is focused on growth at all costs. After all, without gangbusters growth, the person whose name is on the sign doesn't get paid. And finally, with a massive 20% of over-hurdle performance multiplied by leverage then paid out to the firm, tiny margins of difference, say outsourcing HR to a third-party firm that is less effective yet cheaper, make all the difference on the general partner's annual income. The incentives push towards brutality, then this brutality is shielded by layers of bureaucracy, and finally, the US government rewards the brutality by subjecting the gains from it to a lower tax rate. As you may know, the latest fixation of the finance world, even beyond just private equity, is artificial intelligence. Many investors believe that it's as groundbreaking a technology as the internet. And so, it's probably worth learning how it actually works. For that, I'd recommend our sponsor Brilliant. They have a fantastic course on how large language models like ChatGPT work, which, surprisingly, I didn't find all that complicated to understand. But that's potentially thanks to Brilliant. They specialize in teaching complex STEM subjects by breaking them down into small chunks that they teach through intuitive principles and interactive exercises.